joining us for the third episode of our Law in Life series. I would like to start by acknowledging the Darkin young people, the traditional custodians of the land on which we meet today, and to pay my respects to elders past, present and emerging. We are hoping that through our series Law in Life, we can provide you with tools and knowledge that are useful to you when you encounter the law in your everyday life. Today's topic will explore the challenges with buying and selling property in 2022. I am Anna Cruikshank, the Managing Director of Aubrey Brown Lawyers. I'm very excited to introduce our panel today. Firstly, I would like to introduce Jaimie Woodcock. Jaimie is the Principal of McGrath Central Coast and has over 20 years' experience in the Central Coast property market. Jaimie's agencies specialise in selling and leasing residential properties and residential development projects. Thanks for coming along, Jaimie. It's great to have you here.
Thank you.
I'm also joined by Steve Fort. Steve is a director at Investblue and the head of financial planning. He has a wealth of knowledge in relation to financial planning, investment and the lending market. Steve, it's great to have you along today.
Great to be here, Anna.
And finally, I'm joined by Peter Kernan, also known as PK. Peter is a lawyer with over 30 years' experience and a director of Aubrey Brown Lawyers. Peter is also an accredited specialist in property law. Thanks for coming along, Pete.
Absolute pleasure.
So, Jaimie, it's been an interesting property and lending market over the last 3 years. Can you share your experience with the market?
Well, yeah, over 3 years, it's almost like we've had a 15-year market compressed into 3 years, really. I think if you look at, you can almost break it down into pre-COVID market, and then sort of March 2020, the world changed, but so did the local market too. So pre-COVID, we were actually really starting to get some momentum on the back of 2018. The volume definitely came out of the marketplace. So 2019, early 2020, we were seeing some strength returning, definitely some momentum and good volume, which really is a key measure from our point of view, because price increases are exciting, and it's great to have that kind of capital growth outcome for clients, but to see volume in the market normally means that the property market generally is gaining some traction. So then we have the March 2020 impact, where clearly globally things went into a bit of a shutdown. So we were expecting, and I think the headlines were the 30% property crash coming our way. We had probably a 4-week property crash, really. That was it. And what very quickly happened was the Central Coast became a bit of a go-to destination. It was almost like people were seemingly fleeing other areas, but really coming to the Central Coast. So the market, after that 4-week sort of hibernation, what on earth is happening, became the greatest property market of our lifetime, but really. Not just from a selling point of view, but even from a rental perspective. Every vacant property was tenanted within the next weekend. You know, we were having 20 to 30 applications per vacant property. And look, who would have thought over the next 18 months the market would have gone up almost 40% in our region. So you don't know when that's going to stop, because you might think, well, why did people sell so quickly when really there was an extraordinary amount of property capital growth ahead? But you don't know what's happening here. I mean, really, it's been the great mystery the last 2 years, hasn't it, of what's going to happen the next day.
And I think that certainly the approach I've seen a lot of our clients take has been, we've got to buy in the market we're selling in, and we need to buy quickly, because you were seeing properties increase in value by tens of thousands of dollars within a couple of months.
Oh, definitely, yeah. The competition, the urgency, the fear to miss out each weekend was real, you know, and each weekend new benchmark prices were seemingly making last week look pretty cheap, that quickly. You don't see that often.
That's right.
It's a rare occurrence.
And is that still where the market's at in April 2022?
No, I think it's pretty, hindsight, you don't know a market has peaked or troughed until after that time, right?
That's right.
But I think it's fair to say October, November last year was probably the absolute peak of the market. you know, we're seeing a lot less competition and urgency. The commentary in the I think from an economy commentary, from a a general interest rate commentary has shifted, and now it's all about, I think, some headwinds coming our way. There's no doubt that it feels like we've already had interest rate rises.
That's
That's the sort of the impact. I think all of the the conversations that are out there now. It's like we've had 2 or 3 rate rises, which we haven't. They're probably not far away. So the market has made a fundamental shift. You can literally say last year's market is gone. So, but what that means is not that property isn't selling. It just means that we've got to work a lot harder to create that value, to create the competition, to create that environment that was there naturally last year. We now have to be really, really on the front foot to create that now.
And the rental market, is the rental market starting to steady, or is that still really difficult?
No, it hasn't found the peak yet, I don't think. It's got a little bit of a different dynamic, and that means that now that people are perhaps not buying as much, they would lean back into renting, perhaps, and make a change of rental. So, we've been hovering at a 1% vacancy rate for years in our area. We're virtually at 0 now.
Yeah.
It's a tough market to rent in. I remember we had, right when COVID hit, we had a brand new building that had just been completed, just been settled in Gosford, and I think we had 38 of those apartments to lease. And then about a month pre-COVID, we leased 1, and then leased the whole lot on the second weekend of COVID. It hasn't cooled down since then, really. A lot of that was people, I think, trying to find a bit of a safe haven, moving to the coast, away from Sydney. There could be a bit of a shift back, perhaps, to the CBD.
So have you noticed that a lot of the purchasers and a lot of the tenants were from outside of the Central Coast looking to relocate?
Yeah, for sure. Yeah, that's a trend that for the 25 years I've been selling on the coast, that's been a common trend. But it was probably just more ramped up by, I think, that extra sector of people that could work from home. Because that's normally the reason to move away from the coast, isn't it?
That's right.
The lack of professional options, perhaps.
Yeah.
But I think now that it's probably changed forever, really. So yeah, the whole ability to find a good rental, it does actually create a bit of a blockage for the whole market too. Because once again, you're to sell in a market where it's hard to buy, you might take that rental option. When the rental option's even harder, it kind of stops decision making.
Yeah.
So Jaimie, just with a lot of these high-rise developments that are still going up in Gosford, do you anticipate the demand is still going to be there to fill all these? Like, are investors buying these with pretty much an expectation that they'll be able to rent it straight away?
I do. The reason being, PK, is that the house prices have gone through the roof, right? $1 million home pre-COVID's, in some areas it's worth $2 million today. I know that's a dramatic increase, but let's just say the average has gone from $1 million to 1.5 even. The apartment prices haven't moved really. So the value offering, when you've got this significant gap between house prices and apartment prices, means investors who are chasing a yield, investing in a house is no longer a yield scenario. It's a 1.5% yield, whereas an apartment's still 3 to 4%. So I think they will look at that as being good value, price driven. You've got investors still, and the sweet spot for investing is 600 to 900 still. You can't buy a house for that anymore. So I do think that's going to be a really important sector for supplying investor product in that price point. Once again, brand new. People love renting brand new as well. Brand new. The Gosford CBD is definitely showing signs finally, visual, actual change now, which is good. It's not just a story, it's actually happening. So people are far more open to renting in Gosford, not as a value proposition, but proximity, brand new, well-designed architectural living environment, plus the lifestyle offering in Gosford now is starting to ramp up.
Steve, we've had a very, very hectic and stressful property market.
Yep.
What's been playing out in the lending sphere?
Yeah, I think, taking on those points of the fear of missing out, and that pressure that's there from an ever-increasing property market's meant more scrutiny from the government, more pressure on lenders to be doing the right thing. The other thing that's happened in the lending environment, though, is post the Royal Commission into the financial services industry, where there was probably two main outtakes that came from that. So the first one on the lending environment was the requirement for brokers to have a best interest duty obligation to their clients or to borrowers, which has meant that there is that increased onus to act in the best interest of the borrower, which makes sense when you say it right.
Yeah.
But it doesn't hasn't necessarily applied in many circumstances, which has meant to maybe some poor situations for borrowers. I think the second one is really the increased strictness of requirements on borrowers and on lenders to be able to substantiate the deal that they're putting together. So that's meant a lot more delays in sort of sourcing finance and the time it takes to do it. It's certainly meant that there's increased scrutiny on things like justifying your living expenses, or maybe some awareness around having the banks having a clear understanding of what somebody's living expenses are versus them just making up something to get a loan.
So the Netflix and the avocado on toast generation.
Yep, absolutely. So yeah, I think it's been a good environment to source borrowings for those people that can justify it and those people that can come up with good strategies. But it's certainly been tougher for people that are rushing or leaving things at the last minute as well.
Mm-hmm. And where do you see the lending market going over the next 12 months?
Yeah, from an interest rate perspective, I think, and as Jaimie said, there's certainly upward pressure on interest rates. It's pretty clear that even though the official rates haven't moved, that the rates with banks have moved, particularly in the fixed environment. So we can't fix for 5 years at 1.99% anymore. All of that's gone. And there's further increasing pressure as we enter that inflationary environment. I think it was only yesterday that announced the highest inflation figures in a long time.
That's right.
So, there's pressure there. There's also been a lot of pressure on banks because they have been lending out money at too high levels relative to borrowers' incomes. So the Reserve Bank APRA try and keep borrowing levels at below 6 times somebody's income. And last year, about 20% of the loans that were provided were above that 6 times income. So there has to be increased scrutiny and pressure. And I think somewhat interesting to what you were talking about then, Jaimie, is that sort of affordability of rent versus the affordability of repaying a loan. So at the moment, it is much more affordable to repay a loan, particularly if you're on minimal sort of, or long payment terms.
Yep.
In the future, that's going to change.
It's interesting how the APRA restrictions have had such an impact in our market in more recent times, even more so than interest rate.
Yep.
Because obviously we've had a declining interest rate for 12 years.
Yeah.
Now APRA steps in, and they kind of really had such a detrimental impact on our marketplace in 2018.
Yep.
So the things that can change the markets, far quicker than they used to.
That's right. And that comes in cycles too. So back in 2018, APRA really got fairly tough and fairly strict. And then with COVID and everything coming and some concern, they loosened things a bit. But even as recent as I think it was October last year, the APRA requirement to have a serviceability buffer on interest rates increased to 3%. So what that means is when a lender assesses the affordability for somebody, they take the interest rate they're paying, 3%, let's say, and then add another 3% on top, and they assume you're repaying that loan at 6%. And I'm sure those things and other stricter requirements are going to influence the market significantly.
So, Peter, we've had a very frantic property market combined with tightened and more difficult lending conditions. How has that played out in your property practice?
Well, we found that the additional scrutiny that is being placed on these sorts of borrowings is slowing down the approval process to such a degree. For example, even if a client's got a pre-approval, that doesn't necessarily mean that they're going to have the formal approval that will enable us to be confident enough to let them exchange a contract. So we're seeing a lot of people exchanging contracts with a pre-approval, thinking everything's fine, and then suddenly 5 days later realising that, well, no, they're not quite fine, and the the need then comes for an extension of the cooling off period, which places additional stress on the whole conveyancing transaction. It shortens the time period we've got left to complete the transaction because as a conveyancer, you don't want to be doing too much if it's not going to go ahead. So we found a lot of lag in that sort of area, and that further impacts upon even when the finance is approved and you proceed through the transaction. You get towards the end, and there are still things that haven't been ticked off. There are hoops that still need to be jumped through, even though you've had that period of time, and especially when there are additional problems with the borrowing entity, or there could be trusts involved, companies involved, and people don't quite tick the boxes, and silly little things like trust deeds not being witnessed and undated suddenly puts a roadblock, and the bank will just say, well, hang on, you've got to fix that. And then the more pressure comes, and it just slows the process down again.
And it can, sorry, Steve, it can even be as simple as we've had a matter where one of the shareholders in the company was away. And once upon a time, it would be directors of the company who would be providing personal guarantees and, providing their information to support a loan. But now the banks are looking down to the next level. And in this particular instance, the shareholder wasn't readily able to provide identification, and it caused a big delay in the matter.
Yeah, I think definitely in relation to that point, that's an outworking of that further responsibility that's put on lenders to be able to justify what they're doing, and that is certainly an outcome of APRA and the Royal Commission. I think on the pre-approvals, I was just going to add there, historically what happened is you would get a pre-approval for a loan, and that would be all good to go, subject to the property being purchased. Banks over the last 12 months basically stopped pre-approval processes, and they said, we're just not doing that anymore. We'll go through the formal approval process at the time, because either the properties are moving too quick or the process takes too long. So it wasn't working either way. So, which has meant that you can't do things in 10 days or 5 days anymore. It's really tough.
Wow.
Peter, Jaimie's highlighted that one of the opportunities, particularly in the local market, is the apartment and the unit market, and a lot of those have been selling off the plan. There have been some recent changes legally to off the plan sales, haven't there? Yeah,
there have. There were initially it was brought about by instances of developers entering contracts at a certain price. The property market rises whilst they're constructing their development, and usually multi-storey types, and getting to a point where they realised, for example, a unit that they'd sold off the plan 12 months ago for $500,000 tomorrow will be worth $700,000. In these contracts is always what they call the sunset date. The developer has to complete the construction by that date, failing which the purchaser could pull out if they chose. But developers were basically getting to a point where they said, "Oh, we can't meet the sunset date," and saying, "We're going to rescind the contract." And they would just say to the purchaser, "Off you go. You can have your deposit back," and then they'd resell at a higher price. So there were various court cases came as a result of that, leading the government to bring in some legislation which involved some additional layers of disclosure, so that people knew what they were getting as well. But in relation to the delay aspect, the developer now can't rescind a contract without an order of the Supreme Court. So the purchaser could rescind should they say, well, we've waited long enough, forget it. So that if you have got developers in trouble, there can be that issue as well. But the purchasers still have that right, but the developer doesn't. So it enabled that certainty for the purchaser there. And as you say, there are a lot of off-the-plan developments that really came online at the early stages of the property market increasing. So they're the ones that are now selling, and the market seems...
Give the developer a bit of support here. They've had probably a real tough time, albeit the market's been rising. The challenge of construction is extraordinary at the moment. To deliver a project on budget, that's impossible.
Yeah.
If you had a locked fixed in price 2 years ago, you'd be thinking, wow, I've done so well here because I've captured like a 2 year ago price.
Yep.
But the real stress behind that is, can that construction company deliver without going broke at that 2 year ago price? Because they're committed to that price point, but they're now paying 40% more for materials. So it's a challenging space.
Yes, very much so.
It is, and that's why from a buying perspective, and the first protocol for me to be engaging with a client, to be investing in our company's efforts and representing a project, is to make sure that the developer and the construction company can complete the project. Number one at the moment, isn't it?
That's right.
So it's a really interesting space there. And I only say that because, developers do get a bit of a hard time around maybe manipulating that situation. But more often than not, the conversations we have around sunset clauses is to protect everybody's best interests. Everybody's, purchasers included.
And we've seen, obviously, say in Queensland, a few issues with developments. Do you expect more of those issues to occur on the coast?
Well, I hope not. But I think the global experience would say, absolutely. Yeah. I mean, how can we avoid what's kind of happening everywhere? It may get a little bit worse, perhaps. At the moment, China's back in lockdown. It's the greatest supplier of building material globally. It's going to be a problem. Definitely. And so you look at where prices go. Are they going to go downwards because interest rates are going up, or are they going to be potentially have a little bit of a blip on the radar and go back up because the cost of building a new home is going to go through the roof? So therefore, existing homes will be renovated rather than new builds. And once again, the value that's of an existing home is going to be far greater. So it's a tough question to answer. The question you answered a while ago, what are house prices going to do? And they seem to move quickly now, don't they? Either way.
Absolutely.
So, Jaimie, what's your key piece of advice to somebody looking to buy or sell in 2022? Don't try and guess the market too much. You do see that a lot over time. The predictability is gone, really, in that sense. And look, if you're buying and selling in the same moment in time, I think the market is it's a much fairer, more balanced market now. Definitely the stress of buying was pretty great a year ago, wasn't it? It was, absolutely.
It was a really exciting time to be selling because, in that moment of success, and even from our own organisation's point of view, you're feeling like a bit of a superhero each week, achieving these extraordinary prices. But the other side of the coin is you're dealing with buyers that are feeling pretty deflated every Saturday afternoon. They're missing out week after week. That's a tough market. It feels, it's a very one-sided market. I think we're going into a much more neutral market. So the selling process means we're going to have to all work a bit harder, far greater presentation, be more price relevant, and working hard to create that sense of competition and urgency to buy. But from a buying point of view, there's going to be more choice. There's not going to be as much urgency as such out there. Definitely, the lending component will be a bit more challenging, but I always take that with a grain of salt. When you're coming off the lowest interest rates in history, anything compared to that's going to sound expensive, isn't it?
Absolutely.
But look, I think over a 25-year career, I'd say the average interest rate's probably been, retail rate's probably been 6%, let's say, 5 to 6. We will probably end up well below that in 2 years' time, well below average still. And I think that's an important point. It feels like it's going to be expensive, but the reality is it's going to be very cheap money still.
Peter, you and I remember the days of 18% interest rates.
We do not want to go back there, thank you. No.
Steve, your key piece of advice to somebody?
Yeah, I think, probably 2 points. One, not dissimilar to Jaimie's, which is don't try and guess what's going to happen in the future. So don't try and pick the market, whether it's from a property perspective or whether it's from an interest rate perspective. On the interest rate side of things, you won't beat the banks. So you're best off to really spend your time focusing on having the right structure and the right strategy. It's not all about getting the lowest interest rate today. It's about having a suitable strategy that takes into account all of the current risks you're aware of and all the potential future risks that you should be considering, so that when you purchase that property, which is obviously the biggest asset that you're going to purchase, and when you take on that level of debt, which potentially is the biggest level of debt that you're going to take on, that you're doing it in a way in which it's a long-term sustainable strategy so that you can cope with those outcomes. If that means fixing rates or doing things because you need the certainty around your cash flow, whatever it might be, really, self-interested here, but spend some high-quality time with a financial advisor to really support that mortgage broker relationship, so that it's not just getting the right product, it's also getting the right strategy and the right advice to make informed and educated decisions.
That's a really, really good piece of advice. Peter, key takeaway.
I have to sort of dovetail with these guys, I think, because it's all about being ready for what you're doing and getting in early, for example, with your financial advisor, your broker, as a buyer particularly, obviously, to be in a position not to put yourself in a position where it's too stressful. And Jaimie mentioned the number of people that were going to auctions at the peak of that market where they were just going time after time and time after time, but it didn't. They were still prepared, but they had to keep on getting prepared. But it's still, I think, even in this market, it's still a case of you have to have all those ducks in a row to make sure that you're not, again, putting yourself in a stressful position. I think for sellers, it's engaging early with your chosen agent, of course, to make sure that your properties are going to be able to maximise its potential in a market that is a little unpredictable. And I think that to actually get in early and make sure that that is maximised is your best chance of maximising the price. So I just think preparation is the key.
Thank you, Pete, and thank you to all of you. It's been a very interesting discussion today to hear what the current market's doing and where you see it going, and I think there have been some really good tips there for people who are looking at purchasing in the next 12 months plus. The next episode of our Law in Life series will talk about the challenges faced by business post-COVID and how to deal with them. We hope that you can join us, and we would be most appreciative if you would share our broadcasts to your friends and family. Thank you.